This video will describe the contents of the Profit Driver Report, one of 6 reports provided by the Fiscal Checkup software. The focus of this report is to summarize the accounts on the income statement. The Profit Driver Report begins with the top recommendations for improvement as well as other notes to consider. The top half of the page always lists the most significant recommendations, the ones with the greatest impact on profitability and cash flow. The bottom half of the page lists other comments on sales, operating expenses, profit, and return on intangible assets. For those companies with cost of goods sold, page 2 contains an in-depth analysis of this account. On the top half of the page, a brief introduction is provided. If gross margin has been declining, then the introductory paragraph also lets the reader know how much sales would have to increase in order to generate the same amount of profitability that has been lost from the eroding margin. The first graph shows the company's performance in green compared to the industry in red. The narrative to the right monetizes the opportunity if margins have been eroding. In this case, if the company could achieve the industry average, it would generate more than $500,000 in additional profits. Since profitability is directly correlated to business value, the software shows how much value is impacted by the changing margins. In the narrative, we give the specific impact in business value. Finally, we offer some basic suggestions on ways to reduce the cost of goods sold expense. Page 3 is a review of the operating expenses. This section of the report starts with a narrative explaining the significant importance of controlling operating expenses for all companies. The first graph shows the company trend in green and the industry trend in red. The narrative tells the business how much profits have been impacted, positively or negatively, by the performance of the company. As a company grows, their operating expenses per employee should trend down. This can be a very insightful graph, especially for those companies that don't have cost of goods sold. Although payroll is generally part of operating expenses, the payroll as a percentage of sales is an important metric for most companies. This is also an important productivity measurement. Page 4 continues with other per employee metrics. The table on the top of the page lists the 5 per employee metrics that are evaluated by Fiscal Checkup. If sales are growing faster than employees, then this upward trend for sales per employee is positive. Similarly, profit per employee should also be trending upward. For many companies, this graph is a key metric to evaluate overall productivity of the company. The final graph on this page shows borrowing per employee. Borrowings per employee can provide insight, especially when reviewed with the other per employee metrics. Added debt leverage should produce more profit. Page 5 contains an overview of capital expenditures. The page begins with a narrative discussing the importance of capital expenditures. Annual capital spending is calculated by the software and presented here graphically. The net fixed assets to sales ratio shows how well the company is utilizing their fixed assets. This trend is positive. The company is using less assets to generate each dollar of revenue. However, it also raises concerns as to whether the company is delaying capital investments. The asset turnover graph shows the company in green and the industry in red. This company is considerably more efficient than their industry in utilizing their assets with a positive trend. Page 6 completes a detailed analysis of the sales of the company. The top half of the page analyzes the profitability and working capital requirements of sales for the past year. It separates the changes in profitability and working capital that are due to changes in operating ratios from the portion due to the fact that sales have increased. From 2014 to 2015, sales increased by $816,000, but there was an operating loss of $11,000. The company needs to understand why their sales did not generate more profits than the previous year. It appears that one of the keys to the loss is cost of goods sold that we saw previously in this report. The margin erosion for this account negatively impacted profitability by over $134,000. On the other hand, operating expenses as a percentage of sales improved, contributing over $100,000 in profitability. So when you net the loss of margin from cost of goods sold against the improvement in margin due to the reduced operating expenses, the net negative impact of these two accounts was almost $33,000 in 2015. Which means the new sales actually contributed almost $22,000 in profitability, which was able to reduce the overall operating loss. In fact, had this company not had these profitable sales, the loss would have been almost $33,000. A very similar analysis is calculated for the working capital accounts. Here, overall cash management, due solely to ratio changes, added over $93,000 in positive cash flow for this company. The improvements in receivables and inventory were used to pay their bills sooner. We can also see that the working capital used to fund the $816,000 sales increase was over $188,000. This means the $816,000 of new sales consumed $188,000 of working capital. The next section contains a narrative discussing sales and margins as well as the market dynamics. This area uses data from the subjective questions that were answered in the input wizard. On the bottom of the page is a graph showing the operating profit on the new incremental sales compared to the company's historic or base sales. Also on the bottom of the page is a graph of growth rates. In the chart, the green line is the actual growth rate, measuring the change in sales year over year. Note the sales growth trend is positive, but the mustard-colored line is the real growth rate, which is half of the assumed growth rate in 2015, and it's trending down. Now, to calculate the real growth rate, Fiscal Checkup removes the price increase, so a price increase alone cannot be misinterpreted as sales growth, and the changes in cost of goods sold, where a cost of goods sold price increase acts just like a price increase. Both of those are removed when calculating the real growth rate. Sales aren't growing as fast as some might think. The red line on this graph shows the growth rate that can be sustained based on the assets and margins of this company. For each report, there's the ability for the user or business advisor to add comments. If any were entered, they are listed on this final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.